Before we begin, the disclaimer: I am not a financial advisor and this video is for education and entertainment only. Nothing here is investment, tax, or legal advice, and nothing is a recommendation to buy or sell anything. Investing involves risk, including the loss of your capital. Past performance does not guarantee future results. I may hold some of the assets discussed. Always do your own research and consult a licensed professional before making any decision. And welcome to the channel. Here we go deep. We don't do surface level tips or hot stock picks. We break down the real mechanics that move markets and the money inside them, so you walk away understanding how things actually work. Today, the most powerful and most underestimated force in all of finance, compounding, and the quiet thing that steals it from you. Two investors, the first puts in $36,000 total, then stops contributing entirely. The second puts in $108,000, three times as much. Decades later, the first investor, who put in a third of the money, ends up with more. How? The answer is the single most important idea in investing. And once you truly feel it, everything else changes. This is the story of compounding and the silent fee that quietly eats it alive. Let us start from the foundation. Simple interest means you earn a return only on your original money. Compounding means you earn returns on your returns. Your gains start generating their own gains. The interest earns interest. It sounds almost trivial when you say it out loud, but the consequences over decades are anything but trivial. The classic image is a snowball rolling down a hill. At the top, it is tiny and it barely grows, but each turn wraps a larger surface in fresh snow, so it picks up more with every rotation. Near the bottom, it is enormous, and a single roll adds more than the entire first half of the journey. Your money behaves exactly the same way. The early years feel painfully slow, the later years are explosive. The mistake most people make is quitting during the slow part before the snowball has any size at all. Here is what that looks like as a curve: $10,000 growing at 7% a year. After 10 years, it is about 20,000. Fine, it doubled, but watch the shape. By 20 years, it is nearly 39,000. By 30 years, 76,000. By 40 years, almost 150,000. The line is not straight. It bends upward because each year's growth is calculated on a bigger base than the year before. That upward bend is compounding made visible. Notice what is doing the heavy lifting here. It is not a genius stock pick. It is not a secret strategy. It is time. The longer the money compounds, the more violently that curve bends at the end, which means the most valuable input you have is not capital and it is not skill. It is the number of years you let it run. And that is the one input you can never buy back later. This is why starting early matters so much more than starting big. Let me show you the example from the very start of this video with the real numbers, because it is genuinely hard to believe the first time you see it. Investor 1 starts at 25 and puts in $300 a month for just 10 years, then stops completely and never adds another cent. Total contributed $36,000. Investor 2 waits, starts at 35 and contributes $300 a month all the way to 65. That is 30 years of contributions, $108,000 in total. Both earn 7%. At 65, the early investor has more despite contributing a third as much because their money had an extra decade to compound at the steep end of the curve. In dollars, the early investor who stopped at 35 ends with around $395,000. The late investor who contributed for 3 full decades ends with about 366,000. Less money from 3 times the contributions. That 10-year head start, those early turns of the snowball, were worth more than 200% extra in contributions later. Time beat money. So compounding is the engine of your wealth. Now let us talk about the thing that runs the engine in reverse, quietly, every single day, without you ever seeing a bill: fees. A fund's expense ratio is charged as a percentage of your assets every year, and here is the crucial part. It is not sent to you as an invoice. It is quietly deducted from the fund's value every single day. before the price you see is even published. You never feel it leave. A 1% expense ratio sounds tiny, 1%. But that 1% is not charged on your gains. It is charged on your entire balance every year, growing in dollar terms as your balance grows. Picture your portfolio as a growing stack each year, with a slice shaved off the top annually for the fee. In year one, a 1% fee on $100,000 is $1,000. Mildly annoying, but by year 15, that same portfolio might be worth 275,000. So the same 1% now takes over 2,700. By year 25, the fee exceeds $5,400 a year. The percentage never changed. The dollar bite tripled, then quintupled because it feeds on your growing balance. Now, the number that should genuinely shock you, take $100,000 growing at 7% for 30 years. In a near free index fund charging 0.03%, you end with around $755,000. In a fund charging 1%, you end with about 574,000. The difference is roughly $180,000. That is not the fee you paid. That is the fee plus all the growth that fee would have earned, gone forever. Why is the loss so much bigger than the fees you actually handed over? Because every dollar taken in fees is a dollar that can never compound for you again. $1,000 skimmed in year one at 7% would have grown to over $7,000 by year 30. So the fee does not just cost you the fee, it costs you decades of growth on that fee. Expressed another way, a 1% fee versus a 0.1% fee can quietly erase over 22% of your final wealth. Almost a quarter of everything you built gone to a number you never saw on a statement. So you have two forces pulling in opposite directions across your whole investing life. Compounding works for you slowly at first, then explosively. Fees work against you quietly at first, then devastatingly because they too compound, just in reverse. Your job as an investor is brutally simple to state. Maximize the time the first force has to work and minimize the second force's grip on it. To be fair and honest, a fee is not automatically evil. You are paying for something and sometimes it is worth it. A fund offering genuine, repeatable access to a strategy you could not run yourself, or true diversification, or a structure with real tax advantages can justify a higher cost. The question is never simply, is the fee low? The question is, am I getting something in return that I could not get more cheaply elsewhere? For a plain S&P 500 index fund, the answer for a 1% fee is almost always no, because a near identical fund exists for a fraction of the cost. So how might a thoughtful person act on all this with nobody telling them what to buy? First, start now, not when you have more money, because years are the input you can never recover. Second, automate contributions, so compounding runs without relying on willpower. Third, always know the expense ratio of anything you own and compare it within the same category. And fourth, treat every fee as a permanent tax on your future compounding and demand it earn its keep. To wrap up, compounding is the most powerful force you have, and its fuel is time, not talent or even capital. Fees are its silent enemy, small enough to ignore and large enough to cost you a fortune over decades. Protect your time in the market and protect it from unnecessary costs, and you have already won the part of investing that most people never even notice. None of this is a recommendation about any specific fund. That is for you to research. If this made compounding and fees click, consider subscribing, and as always, protect your downside first. Thanks for watching.